Welcome to this complimentary video about basic pivot points. Spotting and then trading pivot points is one of the many strategies that we highlight and practice ourselves here at the Nimble Trader. Just before we get into this, can I say to you, will you have a look at this important word? And please read that carefully. And if you're happy with accepting those terms and conditions, then yeah, please watch the video. You're most welcome. If you'd prefer not to, okay, bye. Hello, I'm Tony Moxon. Let me talk you through the video. What we're going to do, what we're going to look at in this tutorial is, first of all, what exactly is a basic pivot point, how to spot basic pivot points that leap off the chart at us, they really stare at us, and how to trade basic pivot points with the minimum of risk. What exactly is a basic pivot point? Well, if you Google, first of all, if you've got time, go to Google and Google pivot point, and you'll find explanations of how they are the average of the high, the low, and the close of the day, and that if on the following day prices trade above that figure, it's a bullish sign, and if they trade below, it's a bearish sign. And if you look into it further, you'll find that the average is extrapolated to find supposed support and resistance levels. I mean, what can I say? I mean, it all sounds very clever, but there's such an easy way of doing it. There's a much easier way of defining and spotting pivot points, in my opinion. I define a basic pivot point as being where prices fall in a cascade and then clearly reverse direction. The entry point for a trade, if one is going to take a trade, is being the first day thereafter that is both an up day and where both the open and the close are above the open of the lowest down day. Let me run through that one again. It's where the entry point for a trade, being the first day after the cascade, that is both an up day and where both the open and the close of that new day are above the open of the lowest down day. Now, that probably sounds just as complicated as the stuff on Google, and it probably sounds too clever by half. In a moment or two, I'm going to put some graphs up, and the moment you see the graphs, it'll instantly make sense, and I'm sure you'll get it. Okay, so how to spot basic pivot points leaping off a chart at us. There's a great bit of kit called ShareScope, which I use all the time. I don't get paid to bang on about it, but I think it's brilliant. It might well be worth your while. If you're not already a subscriber, it might well be worth your while checking them out. Google ShareScope, follow the links, see what you think of their package. I think it's brilliant. Like I said, I don't get paid anything in any way to plug it. But anyway, using ShareScope, and that's the chart program I've used for well over 20 years now. If I was looking for basic pivot points, first of all, I'd do a sweep. I like doing manual sweeps, to be honest. You can set the data mining function to do these things for you. I prefer to actually scroll through the charts because kind of they stick in my head. Am I a bit old school? Yeah, maybe I am. But anyway, that's the way I do it. So I'd do a sweep. I'd be looking for basic pivot points. So I'm looking for that cascade. And if anything caught my eye, I'd put it on a watch list. You know, if I'm seeing something that's starting to come down steadily, I'll put it on a watch list and just watch it, stalk it. Okay, well look, here's one that comes from the spring of 2018 that did catch my eye. I didn't actually take the trade. I should have done, but I didn't. It's the FTSE 100 index. Okay, there's the chart. Now, the red arrow is marking the cascade. Now, sure, on the 20th, there was what might or might not have turned into a pivot point, but it didn't. So the cascade comes down to the 26th, okay? So all I would do is I've spotted the cascade, I just sit there and stalk it. I just watch it because I've no way of knowing when it's likely to come to an end. Now, have a look at this next slide. Okay, just see on the extreme right-hand side, a very different piece of price action. On the 27th, it looks as though that cascade may be turning round. Now, it's definitely a new look, but I still don't know for sure whether it's turned, but it's now it could just have been a small counter trend move, but I'm certainly now very, very interested in that. I mean, see what I mean? How hard was that to spot? Now, look, I don't know for sure that prices have swiveled round, but yeah, it's definitely got a different feel to it. Now, in this example, the lowest low was on the 26th of March, and as you see, it's pivoted round. Now, it's still overlapping. The new pivot point, which may or may not be forming, is still overlapping completely the body of the previous day, but the price action is so different. So now I am focused on that. I want to see what happens the following day. And I draw two lines. Okay, do you see on the right-hand side, on the 26th, I've drawn a red line on the bottom of the day's price action on the 26th, and across I've drawn a green line on the top of the price action. So I'm defining what may or may not be the lowest low of that current little mini cascade. And what I'm now looking for is an up day in the very near future. It's got to be in the next day or maybe day after, that opens above the green line that marks the open of the lowest low of the cascade, if that's how it's to be. And I want to see no overlap between the low point and what will become my buying signal. Okay, I'm looking now to see, is it really going to pivot round? Okay, next chart going up. There, green arrows marking the point. That's the following day, the 28th. And as you see, it meets the criteria. There's now kind of clear blue water between it and the green line. And that one is actually a very strong looking basic pivot point. And with hindsight, I wish I'd taken that as a trade. The lower line, the line coming on if we focus now on the price action of the 28th, there's a long vertical lower line behind it, but below it rather. That is where, if you like, the bears tried to pull the price down and failed. It's a very strong signal. It's where something comes down, but it can't hold intraday and comes back up, and it means, to say the bears are routed is perhaps a little melodramatic, but nevertheless, the sellers could not hold it. People sold off, but it didn't hold. It came back up. That's a very strong looking pivot point. Now, like I said earlier, how difficult was that to spot? All it took was patience. Now, another slide going up. Yeah, I mean, that was a brilliant move, wasn't it? Look at that. Duh, I didn't take it. Could have made some money there. I think it's worth saying that trading basic pivot points all on their own is pretty ballsy stuff, because not all trades work out as well as this one. But do you see what I mean? They are not hard to spot. What is difficult is sitting quietly waiting and not jumping the gun. There's a grand name for it. Winston Churchill used it in the last war, or the Second World War even. There's been a few wars since then, haven't there? Churchill used it in the Second World War. He called doing nothing masterly inactivity. And it's a brilliant phrase. It's a bit like a spider waiting quietly beside his web. I don't know whether it's experience. I don't know whether they've got enough brain to have experiences, or whether it's maybe just kind of just animal instinct, gut instinct, insect instinct even. It just tells him if he waits long enough, a nice tasty fly is going to turn up for his dinner. Flies are not tasty. I've never eaten a fly, but they're the disgusting things. But anyway, spiders apparently like them. So if the spider just waits quietly and doesn't rush around, he just knows that dinner's going to turn up. And pivot points are the same thing. You just watch cascades come down. Sometimes they work brilliantly, sometimes they don't. But what you have to do is masterly inactivity while you're watching and waiting. How to trade basic pivot points, and you want to do pivot points with the minimum risk. It's really important to contain risk in this game. And I think the trick that works best for me is letting the trades find me rather than me going actively looking for them. Now, sure, I was saying I do a manual sweep, so I suppose in a sense I'm looking for them, but I'm not trying to see things that aren't there. It's really important in this life not to be too keen when you're looking to buy anything. I mean, think about it. Playing hard works well when you're buying houses, when you're buying cars, when you're doing deals. You don't want to seem too keen when you're trying to buy something, because otherwise the seller just knows he's got you there in the palm of his hand. So don't be too keen. And I think a good rule of thumb, and it works really well in the markets as well, and particularly with basic pivot points, don't jump the gun. Don't be too keen to go for it. I mean, obviously I've got to sweep through the market looking for trades, but I only want to take the ones that shine off the page at me. Now, another chart going up. See what I mean? There's been quite a good cascade coming down across the top left-hand side of the chart. Yeah, okay. And that first up day on, I think it's the 31st of October, it looks like that, the 31st of October, marked by sort of the general area of the green arrow. Okay, it looks like it's pivoting round. There was a sort of a dummy run about a few days before, which didn't in fact work, and didn't meet the criteria of a pivot point. But that one looks like it could be forming, but it looks so different to the previous one, doesn't it? It looks a bit sickly and anemic. I mean, back in the day when my money was burning a hole in my wallet, when I first started doing this sort of thing, that is the sort of crappy trade. I thought, oh yeah, no, look, that's pivoting run. We'll have some of that. Whoa. The fear of missing out kicks in, and I'd have thrown my money at that one. Wouldn't have been a good plan. It's just not clever, because look, if you see the trigger day marked by the green arrow, okay, so we've come down, and right at the end of October, beginning of November, it's beginning to pivot round, maybe, and the green arrow is marking a very, very anemic turn. It's it's above the green arrow, but the green line, but it's not looking good, not clever. It hasn't broken free. Now, the price action the following day does in fact break free, but it's a down day, so that doesn't count. So this is a pretty anemic one that just didn't work, and as you see, it didn't work. It just carried on cascading downwards. So it's really important to pick the right pivot point. They've got to look good and strong. And it's worth saying that trading just basic pivot points is a brave call, because they've got a tendency to be unstable, and generally only the strongest ones work well. When they do, they're highly profitable, because it gets you right in at the start of a move. Now, there's a way, in fact, that I actually trade pivot points which is slightly different to this. I look for some more confirmation. I look for some other confirmation in addition to just the basics. And that's the subject of another video in the Nimble Trader archive. But and those confirmed trades have a higher likelihood of success, but they usually take longer to form, and the ones that are working, well, the move's partially gone through, so by nature they're less profitable. It's a case of it's a compromise. The trade with confirmed pivot points, the trade is more likely to succeed, but the profit is less. So basic pivot points are pretty ballsy, but when they work brilliantly. Okay, let's recap the process for capturing them, and then watch that first example and see how it plays out. That's the first example we highlighted. So what I do is watch the downward cascade that is the mini retracement, waiting for it to bottom out. I'm just stalking it like the spider. And when it appears to have turned, then it gets my full attention. I pick basic pivot points that look powerful. They've got to look, that's what I'm struggling to find, unambiguous. I can't say it. Unambiguous. They've got to look powerful and unambiguous. I want to pick ones that look as though they ought to work. I mean, sometimes they don't. That's just the nature of the business. And the way one compensates for that is by ruthless risk control. It's really important to put stops in place and to action them, and not to bet the farm. And once again, it's stuff that's covered within the archive of the Nimble Trader. But I want to pick strong looking ones that look as though they ought to work, and I don't want to take any that are weak and feeble. I then draw the lines and I watch and see what happens. Once the initial move has begun to look as though it's turning, I wait a day or two, but I can't wait too long, otherwise it isn't a pivot point, it's going to be a consolidation. So I wait a day or two for the up day that comes with no overlap to the lowest low. And if one doesn't happen, well, it's proved to be anemic and just let it be. And if it does happen, then I enter the trade, and I enter very late in the day that the price is set up, because pivot points are powerful. When they work, they work. And if you delay a day, you can often get sort of, the market just goes away from you. So if I've spotted something, I like to enter it just a couple of minutes before the market closes. So I enter the trade, if I'm going to, very late in that day, and provided the price hasn't gone too far from the green line. If it's just exploded upwards, then the likely risk-reward ratios aren't in kilter, and it doesn't make sense. I just say, well, it was good, but it got away from me. That's the way it goes. So enter late in the day, provided the price isn't too far above the green line. And obviously I have to make sure that there's a decent risk-reward ratio in. I don't want to be having too much downside risk. In this example, the stop loss position would be just below the green line. Okay, so looking at the chart, the little green arrow marks the entry point, and the red arrow, which is coming down to the green line, about 125 points or thereabouts below the entry, indicates where the stop will be. I put it just below the green line. Because think of it this way, if the index went back there, well, it would mean that the basic premise of the trade was broken, because if it's gone back down into its zone again, then it hasn't pivoted round. So, I need to come out. I mean, after all, if I was going to take that trade, it would have been taken because the premise would have been that prices have pivoted round, and if they fell back again, well, that would call the whole thing into question. And, I don't want to be anywhere near it. I'm not just wanting to buy it for the fun of buying it. I want to buy it because I think it's pivoted round. Now, once a trade like this is up and running, so let's assume, as this example demonstrates, it has pivoted round and away it goes. Once it's up and running, there are many ways to manage it depending on your profit objective and your attitude to risk. There are more ways than I'm going to run through here, but here are 5 logical strategies that one could use for managing a trade that is working. First of all, having established the risk inherent with the chosen stop loss, depends where the stop loss is in relation to the entry price, and that determines to some extent how large a trade you take. Once again, subject for tutorials which are in the archive of the Nimble Trader. In this case, the stop loss is roughly 125 points below the entry. So you need to pick a profit target that's around twice that. So looking for a profit of about 250 points, and before entering the trade, looking to see, now, is that logical? Is it likely to happen? And if so, well, the blue arrow in this occasion marks where a logical profit take would be. It's twice the risk. Yeah, nice sensible way of doing it. Another way is to arbitrarily pick a profit target that's about twice the risk, but do it at a logical point just below where the trade is likely to find resistance. Look back at the cascade, look for some consolidations, and see where would there have been, where is there likely to be some resistance to the new up move. So put a profit target just below where that resistance is likely to be, take it there. A particularly risk-averse trader might want to start scaling out of a trade at a predetermined profit target so as to pretty quickly lock some profits in. And if they've taken, a large enough position, they might take the view that, well, we'll scale out either 3 times or twice. So take off a third of the position here, a third of the position there, a third of the position finally, or perhaps do it twice. A very aggressive trader would do the exact opposite, and they would scale into the trade, increasing the position size every time it broke up from a short-term consolidation. Imagine a set of stairs, a bit like running up a set of steps. So a very aggressive trader will put more money in every time it broke out from another little mini consolidation and appeared to be going upwards. And the final way that I'm highlighting here, there are other ways of doing it, but the final way I'm highlighting here is to use a moving average. Now, the longer your timeline, the longer the average you'd use, and you'd stay in the trade until the price declined down through the average. As I said earlier, it's worth saying that trading basic pivot points without extra confirmation really is a ballsy option, and I personally prefer to take confirmed pivot points. They tend to create more consistent profits, albeit smaller ones, but each to their own. If you do use basic pivot points, if you get good at finding them and you get good at picking the ones that work, you will make money because you're getting in right at the start of a new move. There's a large archive of videos, podcasts, and written articles on our website, The Nimble Trader, and we add new material every single week. In addition, we operate 2 real money model portfolios to demonstrate different strategies in action, and we publish daily and weekly market reports. And all of that, and there's even more, believe it or not, and it's available to our subscribers for less than the price of a cup of coffee a day. I mean, value or what? So listen, if you're new to trading and investing, or you want to improve your skill set, and if you're interested to find out exactly what we offer, if you'd like to get in touch, we'd love to hear from you. To help you decide if you'd like to come and join us, we offer a no-strings-attached 1-month free trial. To take us up on that, all you need to go is to this website, https://www.thenimble.trader.co.uk, https://www.thenimble.trader.co.uk. And if you do that and then just follow the process, you're most welcome to have the month's free trial, and then you can read all the articles, listen to the pods if you'd like to, watch the vids, see what you think, and if you like it, come and join us. We'd love to have you with us. Okay, thank you very much indeed for watching this complimentary vid. Talk to you again soon, perhaps. Take care. Bye-bye.